Hello and welcome to CMS Forex News. I'm market analyst Nick Nassad. Today is Tuesday, May 5th, 2009. The Reserve Bank of Australia left their key benchmark interest rate unchanged at 3%, which is the lowest rates have been in 49 years. Following the aggressive string of rate cuts that have brought rates down from 7.25%, Governor Glenn Stevens judged it's time to assess how the rate cuts and government fiscal stimulus will work on the economy. The accompanying statement pointed to some positive signs that could support a recovery in the economy, including a pickup in China, a firming of commodity prices, and the considerable economic policy stimulus in train in most countries that should help ease the global downturn. Stevens also pointed to loose monetary policy, which has brought market and mortgage rates to very low levels by historical standards, and business loan rates to below average levels, which has reduced debt servicing burdens considerably. The Australian services sector contracted at a slower pace in April, with the services PMI increasing to 39.8 from March's 35.6. The data provides some glimmers of hope, with the pace of decline easing and new orders in particular showing some upside. In a second release from Australia, building approvals rose in March for a second straight month, a positive sign for the Australian housing market. With sharp interest rate cuts increasing affordability and government grants helping first-time buyers, demand is on the rise. Compared to a year ago, permits are down 16.5%, though that's still a vast improvement from the 30% decline seen in November, December, and January. The Aussie hit a fresh high for this year overnight near 0.7477, though it gave up some of those gains in New York trading. Today's high goes back to November 5th of last year, and the pair seems to be breaking out from important resistance this week from the 0.73 level. In the Eurozone, producer inflation fell another 0.7% in March, with the annual rate showing a 3.1% decline. Such weak producer prices should keep inflation low, which opens up the door for more rate cuts from the ECB, but also presents a problem of deflation which could hurt businesses and assets. The ECB has been more gradual to cut rates and start any type of quantitative easing program, and many traders are interested to see what the ECB has to say when it concludes its meeting on Thursday. The euro-dollar pair traded sideways today, falling overnight to yesterday's resistance that turned to support level at the 1.3330 level. From there, the pair retested its high near 1.3440 following the New York Open, but then retreated again, breaking below that before-mentioned 1.3340 level. Despite a better U.S. services report and some upbeat comments from Fed Chairman Bernanke, U.S. stocks were down, which pushed the pair lower in afternoon trading. In testimony today, Bernanke said that he expects economic activity to bottom out, then to turn up later this year, as the housing market is beginning to stabilize and that the sharp liquidation that has been in progress will slow over the next few quarters. He warned that even as growth returns, though, unemployment may remain high, and that another setback in the financial sector could undermine any recovery. The pound-dollar pair continued its climb that has brought the pair up from 1.4520 to an intraday high today of 1.5160 in the past 6 sessions. Today's high was the strongest the pound has been versus the Greenback since January 12th, as it broke above resistance at 1.5060. However, just as in the euro-dollar pair, later New York trading saw the Greenback regain a part of its earlier losses. In Switzerland, consumer sentiment took a sharp step backwards in the first quarter. The SECO survey index fell to negative 38 from the fourth quarter's negative 23. That puts the index at its lowest level since 2003. While there have been some indications of turnaround in macroeconomic indicators in the US and the Eurozone, Switzerland's recession remains very deep, with increasing job losses a major factor in pushing down consumers' moods. In March, Swiss unemployment stood at 3.4%. The Swiss Central Bank has cut rates to 0.50%, so there is little scope for more loosening monetary policy. The US dollar-Swiss franc pair strengthened in favor of the greenback following the Switzerland release, retracing part of its fall from yesterday's session. Then the pair retested its intraday low near 1.1245 before climbing in favor of the dollar once again in New York trading. And another sign that the U.S. recession may be easing, the timeless measure of the services sector showed contraction in the sector slowing. The ISM index rose to 43.7 in April from March's 40.8, though any level below 50 still represents a shrinking sector. The reading, though, did beat economists' expectations. The services sector in the U.S. makes up almost 90% of the economy, so it's a key index to monitor to see if there is any kind of recovery. Tonight, the UK will post data on consumer confidence, while Australia will release reports on retail sales and its trade balance. Overnight, the Eurozone posts its retail sales, and the UK will release its services PMI along with the BRC Shop Price Index. Tomorrow, the US will post its ADP employment change, and Canada releases data on building permits and its IV PMI. And that wraps up today's coverage of the Forex market. Thank you for joining us here at CMSFX.com, and happy trading.